Everyone, welcome back to the Saltivation Podcast. We have our favorite recurring guest, Miss Diane Yetter with the Sales Tax Institute with us today. So thank you, Diane, for joining us again on the Saltivation Podcast.
I'm thrilled to be here with both of you. I'm excited.
So let's start with a big trend that kind of both of our groups had identified in our issues to watch lists, and that is revolving around the states that have repealed their transaction thresholds for determining Nexus kind of under the Wayfair standard that started with, $100,000 and 200 transactions. Um, there are about, or at least 14 so far, who in various stages of kind of Wayfair have eliminated that transaction threshold. Um, and we've seen a lot of states kind of continue on with this trend. Why do you think this is occurring?
Well, I think this, definitely goes to the undue burden on small sellers in particular, I should say. And, this is what I really brought out in my 2022 testimony before the Senate Finance Committee, as well as when I was asked back late last year in September to talk again about what is the burden on small businesses. And so I think that the states that are doing this, if you look at it, the most recent ones really are streamline states. And the Streamline Sales Tax Governing Board, after my 22 testimony, made a recommendation to all of the streamlined states that they eliminate the 200 transaction count. They saw that as a valid point that I made in my testimony, and that it was a big risk to some potential federal, legislation that might happen. I truthfully don't think anything's going to happen, but I think it's great that the states listened and recognized that. And so in 23, we had South Dakota eliminate theirs. We had Louisiana eliminate theirs, and then North Carolina. We also just this year, Utah just passed theirs. That will be effective July 1. New Jersey has a bill pending. So I just saw the latest update. The legislature asked for a fiscal note. The executive branch came back and said we can't quantify it. So it was kind of an interesting discussion of then legislative research wrote something up that was interesting. And then there had been a rumor that Illinois was going to eliminate it. I had talked to the director last fall. He was not aware that any of this sort of stuff was happening. And then I saw him a month later at another conference, and he announced that this was something he was going to take up. It just got added last week as an amendment to Senate Bill 752. So we will track that. That would make it, that would eliminate it as of January 1 of next year. So I think these are all great things. I think this is eliminating a burden for the smallest of the sellers. And I think it's a really smart move of all the states to be doing this.
So would you say this is a kind of taxpayer win?
It is definitely a taxpayer win. The thing that you have to watch out for, particularly those really small sellers, many of them sell on Amazon and they have their inventory in Amazon states. Now, some of the states have said that Amazon inventory will not create physical presence. Illinois is one of those states. And so what you have to watch out for is remembering, and we run into this every time we talk to a new client, is they think the only economic or the only nexus they have to worry about is economic nexus, not realize that a remote employee in a state or a inventory in a state or traveling in service in a state, that all of that can create that physical presence that actually makes it much more challenging. And so these eliminations of the transaction counts only work if you are truly a remote seller.
So, Illinois' I guess, directive on the physical presence piece and the inventory not creating, that duty then. Um,
Mhm.
did they put that out in a regulation, or how did they announce that?
It is not statutory.
Okay.
I'm trying to remember if it actually went in a reg or if it's just in I think it's just in their remote seller bulletins,
Okay. Okay.
that they came out, and in 2020 when Marketplace came in, that's when they pulled it out.
Okay. Okay. I think that's interesting for our listeners too, because we get those questions a lot, even on the income tax side, right? And so I think
Mhm.
there it just is a little bit of a cautionary tale, right? That maybe it might not create sales tax nexus, right? But there still could be the income tax nexus that could be triggered, just depending upon the state and what maybe they've addressed in their
Exactly.
in their publications or whatever the case may be.
Right. And I think, the New Jersey bill actually because if you follow it from the income tax perspective, New Jersey has taken the position that the economic nexus threshold of 100,000 or 200 transactions is not only for sales tax
Hmm.
but also for the corporate income tax. And so this proposed bill eliminates it
Hmm.
from both sales tax and income tax. So at least New Jersey is recognizing that it has to make that change, to both of those. But
Right.
separate
Right.
from that, the states that are pursuing Nexus, have seen, as I'm sure you guys have, Michigan has started getting very active on sending notices to companies that may be registered for sales tax and not registered for income tax, and or that they maybe didn't register early enough. And so those started coming late last year, and another round just went out because we've got a new round of people calling us and saying, "I just got this notice from Michigan. What do I need to do?" And, we've gone back to Michigan, with a couple of clients that have really de minimis inventory in an Amazon warehouse. And they're saying, we don't care that it's an average of $100 of inventory in the state. That's physical
Mhm.
presence and you're subject to income tax. So we're starting to, see that raise its head a little bit more. And I think you're exactly right, Stacy, that sellers that are only looking at this from the sales tax perspective really need to look at it from the income tax perspective too.
Well, and what about, if Illinois repeals their 200 transaction test, but effective 1/1/2026, what if you've had 200, like if you're doing kind of a Nexus study now, you have more than 200 transactions now, but then you won't that's your own, you don't exceed the dollar value. What about kind of this purgatory period of history versus what the rule is now? It's like, do you just kind of let it be? Because under the guise of, and this is not tax advice for any listeners who may be applying, right? Like, just kind of food for thought on, okay, well, is it kind of the intent of the state to just kind of, it's not material because we're willing to get rid of it? It's like the rules are what they were for this kind of window of time and they're not now. So like, how do you play that game?
Yeah, I think it's a question that has to be looked at on a case by case basis and even a state by state basis. When Washington first repealed theirs back in 2019, their 200 transaction count had only been in effect. I think it was for 6.5 months. I think it was October to mid March, I think is when Washington repealed theirs of the next year. And Washington said, we're not going to pursue for those 6 months. But where we're talking, 7 years, I can't imagine that Illinois is going to walk away from that. I think if it's, just recently that you crossed, they might walk away from it. But if it's going back to 2018 when it first came into effect, we've seen Illinois pursue the physical presence with the inventory for the first couple of years before that change happened. So I think it's going to depend on the states. And then I think also what is the state's position on when do you get to say I didn't have it, because all of these states that we're talking about, Illinois, it's a rolling, 12-month look back. But Utah, New Jersey, those are current or prior year. And South Dakota, when they repealed theirs, said it was repealed as of July 1 of 23, but because of the current or prior year, if you in January through June of 23 exceeded the 200 transaction counts, you had to stay registered through the end of 24, is how South Dakota
Oh,
interpreted that.
interesting.
Wow.
Yeah.
Um, Now North Carolina, they said even if you were above the 200 transaction count, but you were below the 100,000 in January through June of 24, because theirs came out July 1 of 24, you could deregister as of July 1 of 24. Indiana
Mm.
also repealed theirs last year, and they repealed theirs retroactive. I think the bill passed in like March or April, and they repealed it back to January of 24. And so they said if you were below it in 24 or in 23, you could drop as soon as the bill was passed. So it'll be interesting to see how Illinois kind of interprets that. That isn't in the proposed bill. It is a question in the streamlined disclosed practices that we got added into disclosed practice number 8 that asks the streamlined states, when can you deregister if the state has dropped? So we'll have to see how Utah and subsequently New Jersey, if it passes, how they answer that question.
Yeah, it's good to know, and or as a reminder for the listeners, right? That I mean, let alone all the like enforcement dates versus, enactment dates just from from when Wayfair was passed, right? And then
Mhm.
we're struggling with some of that with some of these, repeals of the transaction count, and or if some of these states have even changed their thresholds, right? So these are constant struggles, right? To know, okay, do like when you mentioned South Dakota, right? That's trailing nexus, right? They kept with that trailing nexus, but maybe, like you
Mhm.
said, some of those states didn't, right? So it really is hard for taxpayers to keep track of, and
Right,
continues to be.
right. And the other kind of slightly related trend, streamlined within their disclosed practice that we worked on to get all these questions answered. One of the things that came out of it is some of the select questions, the Streamline Governing Board agreed to define a best practice. So this is the best practice for the state. And removing the 200 transaction count, that was a best practice that got adopted. And then more recently, we got past an adoption that the grace period after when you
Mhm.
cross the threshold, that you don't have to register until the first of the month following 30 days after
Mhm.
you cross the threshold. South Dakota was a next transaction state, and this year they passed legislation that it moves it out to the first of the month following 30 days. So South Dakota is definitely taking the lead on making these changes, which I think is great since they were the state in the case.
Right. Right.
And so, we've talked about Illinois already, which is, for those who haven't listened to Diane's first and second previous episodes, is based in Illinois. And we talked about the last time we talked, pet meds was still, we hadn't gotten a decision out of pet meds.
Mhm.
Um, and so do you want to maybe talk us through or catch us up on, the results of pet meds, what the legislator did as a result of that, and how that's kind of impacting taxpayers, and, you know, maybe we need to bemoan some things, maybe not, but kind of catch us up on kind of what happened with Illinois and the leveling the playing field and what's come out of that.
Sure. So to take you all the way back, Illinois, prior to 2021, um, their tax structure is a sales tax, which we call the retailer's occupation tax, which is an origin based tax for transactions that occur within the state of Illinois. And the tax rate is dependent upon where the seller is located. For sales that originate outside of Illinois or where inventory comes from outside of Illinois, that is subject not to the retailer's occupation tax or sales tax, but to the use tax. And the use tax has no local tax. It is only the 6.25% rate. So for any sellers, remote sellers, or even sellers with physical presence in Illinois, but maybe the inventory and the order acceptance and everything came from outside of Illinois, they would only have a requirement to collect tax at the 6.25% rate. Now, there's a long sordid history of how you determine what is the origin of the transaction. With the leading case back now, gosh, I've lost track of what year it was. The uh, uh, Hartney oil case. I think that's the right name. Hartney oil. And so that defined an 11-prong test that we go through to determine what is the sourcing. Okay. And so that was in place. 2018 comes, Illinois enacts economic nexus, and most of these sellers are located outside of Illinois. So the only rate that is being charged is the 6.25% state rate. And all of the locals are up in arms screaming, "Where's our Wayfair money? Where's our Wayfair money? We're not getting any of this money." And so the legislature went in and passed a law that said effective 2020, why am I drawing a blank? 2020, 2021, that now remote sellers are not subject to the use tax, but they are subject to the retailer's occupation tax. And that meant that all of these remote sellers were required to charge state and local rate at the destination. So that remote seller, let's say it's you guys, you're located in Colorado, you're a retailer, you're selling to me in Chicago. The Chicago rate is 10.25%. But the use tax rate was just 6.25. So you were charging me 6.25% rate. This law went into effect. You now had to charge me 10.25% rate. Um, and so the argument that was made, because Illinois is an origin state, is I could buy from a vendor in another city in Illinois at a rate lower than 10.25%. And now this out of state merchant is disadvantaged and is required to charge a higher rate than what an in state vendor. And so for a constitutional uh, challenge to this is what happened with Pet Meds was the first one that did that. There's been a number of other cases that are in the works right now that made the argument that this was a unconstitutional law change because it did put a higher burden on out of state sellers than on in state sellers. We have a prior case from Missouri, the Associated Industry case from the late 90s that went to the Supreme Court that said you can't have a higher rate imposed on out-of-state sellers than in-state sellers. So that was the argument that Pet Meds made along with these other cases. We were hopeful that we were going to get a decision on this. The Pet Meds case ended up settling. So we don't have a decision on that yet. There are still some other cases in there. But what happened in January of 25, Illinois changed the law once again that said now all out of state sales, whether the seller has physical nexus in Illinois or not, if they were only required to collect 6.25 under our crazy 11-prong test, they now have to collect tax at destination sales tax. And so I think Illinois thought that this change would make their constitutional challenges go away. But all it did was it made more businesses now subject to this unconstitutional challenge and discrimination really is what it is, because still if I buy from an in-state seller that has a lower rate than this out-of-state seller, I as an out-of-state seller am discriminated against. So it'll be interesting to see what happens. This bill that I talked about to eliminate the 200 transaction count, it has included language that I think is very onerous that says if the seller does not provide all of the documentation of where all the sales went, the department, instead of asking the seller to perfect their return. So in essence, if they submit an unprocessable return, which would probably mean they didn't attach their local schedule, the ST2.
Mhm.
Instead of waiting for the taxpayer to submit that to perfect the return, the department has the right to just assess a tax of 15%, which is higher than any other tax that exists in the state. So I think they just keep piling more and more discriminatory provisions into their statute. And I'm hoping to God we get a case that actually gets to the courts.
Well, and that, kind of language in the bill about perfecting the return, for those who have never tried to file an ST2, Stacy and I had a conversation about this the other day. Um, it's hard.
It's hard.
It's very difficult.
Oh, it is. Yes.
And
It
it's long. There's
is.
not a simple way to file it.
You can't upload
Uh,
it. You can't, Missouri is notorious also, but you can at least, upload or send a file to the department and they'll add all the locations for you. Illinois won't do any of that.
No.
There's no
Mm-mm.
easy way to do it.
Right.
And so it is a huge burden. We've talked to the department about that. They seem like they're willing to listen, but nothing is changing.
Yeah, because I mean, not that, we like to win worst state, right? Or nobody wants to, right?
Mm,
But when I started looking at the return after Illinois changed their rules, even as a remote, we have plenty of remote sellers that, sell into Illinois. And so when the rules changed in 2021, we had several clients that, were grappling with, okay, now, we know that we need to collect and all, for all the locals, let's
mm,
start reporting. And then that, became an eye opener where it was, no, this is a very onerous return and
mhm.
takes a lot of time. And if anybody's familiar with the Colorado return, it's also very onerous and, large. But I think Illinois actually might have beat us with this, with those changes.
Yeah.
So you
Well,
guys,
what
you
was
guys might
funny.
win now.
Yes, we might, um, which we have said to Illinois, "You are trying to beat out Colorado, notoriously known as being the worst." Um, and, what I think, was a little bit comical when that happened in '21 was you had to go in and register at least one locality. And then it was supposed to be the rest. As you filed, you would just add them in, and it was supposed to be no big deal. Um, we had a couple of clients that when they did the first return, that activated all of these locals, it automatically triggered the mailing of for every different location, you get like a sub license from Illinois that is a copy of your sales tax license that you're supposed to post. And each location got their own. They ended up with like 3 copy paper size boxes
Oh,
of licenses that got shipped to them. And I was like, what did this cost the department to print and then mail all of these?
right,
I'm like,
right.
that is insane. And we called the department and said, what do we do with all these? And they were like, yeah, we couldn't figure out how to suppress that. Just shred them all. There's no need to hold on to them. And it was just like, oh my God, what?
Wow, wow.
At least they got that figured out, that I haven't heard of that happening again. But that was insane.
Yeah, but like to I mean, your earlier point that you made as is was well heard because we've pushed back on the department as well with, even voluntary disclosure data to say, okay, can you run this through your system? And they will not do it.
Right.
So, I do hope that they will streamline some of this going forward because it is really time consuming for taxpayers.
Yeah, well, and if you have to do whether it's a voluntary disclosure or just you have to amend a return, anything for those prior periods, I think they changed the system, I think it was in '24. So any dates prior to that, they can't take any sort of
Right.
upload or, you have to manually
Yep.
key it all in, to the system, and it is so onerous.
Correct. And I mean, we have several voluntary disclosures where we'll have to do PDF returns as well,
Mhm,
for some of those prior years. But the
mhm.
ST2 needs to be attached, right? Because
Yep,
that all started in 2021. So yeah,
yep,
we feel the pain. And I guess all we can do is hope that the department will streamline it going forward.
yeah, they've gotta wake up.
Fingers crossed.
Yes, yes.
Ugh.
Well, and do you think there's any hope that maybe Illinois would go to an election like, Texas did, Alabama did for just kind of a consolidated rate and just be like 9%. That doesn't violate any sort of, key tam stuff that you can just kind of elect to be a remote seller, charge a single rate, um, as kind of a
They
troubleshooting mechanism.
Yeah, they did. There is a proposal, and I forgot about this to check on the status before our call. There is there are two amnesty proposals that are pending, one from the governor and one from the department. And in the amnesty proposal by the department, which is only for remote sellers, it is only under that amnesty instead of having to do all of the locals that you could do a flat rate. And I believe that flat rate was a 10% rate, I think. And then I think it was a 2% rate if it's the food and drug rate instead of the local on that. But it was only under that amnesty provision. So, I think that at least helps with the VDA sort of situation. But it's only if you qualify as a remote seller. And we'll see if those
And with the
competing,
amnesty, are they talking?
which of those competing amnesty bills might actually pass.
One, would an amnesty be eligible for kind of, is it only net new sellers or is it, hey, I either am non-compliant because your return is too hard or any sort of just like, hey, we just want to get taxpayers caught up and get the money in the state.
It was a little unclear on that, Meredith, because of how the bill was written. I think the governor's proposal is a more traditional amnesty, and it applied for all tax types, and for registered and unregistered. But the department one, I think, was only for unregistered remote sellers, if I
Interesting.
remember right.
Hmm. Well, lots to lots to keep our ear out of the ground,
Yes. Yes.
uh,
Mhm.
going on in, mine and Stacy's former home state.
That's
Yes.
right.